Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, October 13th, 2023. S&P 500 currently sitting at 4327. I'm David Zarling. I'm sitting here with a concert expert, Ian McMillan. You have your favorite baseball team in the playoffs.
Not anymore.
Oh, yeah, I'm sorry. And the Chiefs.
Chiefs won.
Yeah, do they even have a loss?
Yeah, they lost the very first game of the year to the Lions.
The Lions are legit.
They are.
And I'm sorry about your Braves, but they did make it pretty far in the postseason.
Yeah, I've got some mixed feelings. Definitely feels like we left. And you have the best offensive year in franchise history.
Yeah.
Getting knocked out in the NLDS.
Right.
Is a little bit of a bummer.
Yeah.
But it was a good regular season.
Yeah, it was. I mean,
I'm thankful for it.
And wasn't Acuna a record setter?
I would trade in. He was many. So is Matt Olson. I'd be fine with a disappointing sports season if it means we could get stocks into some type of broad uptrend.
Yeah, like you brought up.
I would trade that in. I trade that in 10 times out of 10.
Yeah, like you brought up mixed feelings. Like, and I know last week we talked about, hey, is it too easy that we're coming into a volume weighted average price? We're coming into a 4180, a 200-day moving average, the August high. And we did get response there.
Mm-hmm.
You know, it's not like we didn't. In response, I mean, upward resolution.
Yeah, bounced into Monday and Tuesday.
But we're talking about the S&P 500, which is a cap-weighted index, and that's all good and great. We're not here to say that it shouldn't be. But when we look at other things that happen underneath the surface, we continue to narrow. We continue to see weakness underneath the surface. While, yes, the NASDAQ and S&P up on the week now, it's barely, right? You know, some of these weekly candles that we're looking at have what's called a high wick or a tail on the top. Mm-hmm. But you look at something like small caps, and it's on the verge of the lowest daily.
Yeah, we're hanging on by a serious thread here.
This small cap, the next. So if you think about the S&P 500, and then there's the next 500, that's the Russell 1000, and then the next batch in order of market cap is the Russell 2000. Mm-hmm. The Russell 2000 has been abysmal. I mean, it's negative on the year. It's approaching its lowest daily and weekly close that we've seen since October of 2022. It's at the bottom of this 20% range, this range that's gone on for 18 months.
Flat 200 day.
A flat 200 day, which it means hot mess. You have micro caps, which that's the next batch lower, that are breaking to brand new lows as we speak. That's a problem.
As we speak. I got them on the phone. I'm trying to talk them through it.
Yeah, can you?
They're on the hotline.
Did you ask them to find some buyers, some demand?
I am willing to go door to door this weekend around my own neighborhood to find buyers.
Yeah, who are you starting with first? Who do you think of your neighbors who's coming out and buying stocks?
Ooh. I think the Hungarian couple next door.
Excellent.
Edie and Balish.
I love it. And like, for example, microcaps are at the same spot they were in January of 2018.
Oh, gosh.
And you've got small caps. This level is so critical. And the reason why, and really this area is 165 to 170, currently sitting at 170.14. And that's the 2018 high. That's the pre-COVID crash high. It's the lows from June of 22 and October of 22. And they have not had the same response as some of the large cap names. And even when we look at some of the large cap relationships, you know, if you look at Qs versus the S&P, we are up into a level that we were at in February of 21 and November of 21. And that's when we saw sellers show up, meaning the supply outpaced demand at a greater rate for the NASDAQ 100 than even the S&P 500. So
wow.
fell more. And that's not what we're calling for. It's just an interesting environment. It's a mixed feelings environment. And not that investing is about feelings. It is about the data. You have some of these broader indices that are below important levels. Like, for example, I remember a couple of weeks ago, you talking about the NYA or the New York Stock Exchange Composite.
Yeah.
And the 16,000 level. And we're still below that. And we're below a 200-day moving average.
And same with the Dow, below 34,000, below a flat 200-day.
Right.
And isn't that wild? So you've got the NYSE Composite, which is, how many stocks? Thousands.
Right.
And you've got the Dow, which is 30. So as far as concentration, like absolutely, totally opposite ends of the spectrum. Dow is by far the major index with the lowest holdings.
Right.
Significantly. And the next, NASDAQ 100 has over three times as many as the Dow. And yet both arguably the exact same behavior over the last, you could say 18 months. You could also say, we're coming up on close to, we'll see where we are as we get into Q1 next year. But we're not far off from like a 4-year range of, or I'd take that back. It would be 3 years if we got into Q1.
Right. It's a long time.
3 years.
That's a long time.
We've had a lot of 20% rallies and a lot of.
When I thought that was such a good point last week about how many bull and bear markets there have been in small caps since April of last year.
85.
It's crazy that you have, I think, going back to your point, the Dow Jones 30 stocks being below an important level, NYSE Composite, about 2,000 stocks approximately that are below 16,000 on that metric. You look at microcaps being below 100. These don't give you the warm and fuzzy. Like, we want to see a broadening out, because really what we've seen, while June and July were nice because we got back above 4180, we moved higher. We've now pulled back, and this is a pullback is normal for August and September. And last week we talked about, is it that easy that we're heading into this area where we see demand? And we saw it in the first part of this week. But when we look on a relative basis being comparing one thing versus another, when we compare small caps versus large caps, they're breaking below lows that we haven't, like lower than the COVID lows. So think about that. There's that much damage going on that we're below the COVID lows in those relative relationships. That's important information.
You take micro caps, so we're now back into, most technicians should remember this, but the August, September, October ranges in 2020. Okay. When we came out of the V bottom, and then that end of summer was real rangy.
Yep. You're talking off the COVID low into that summer.
Yeah. And then so if you take the S&P, for example, S&P obviously looks a lot better. So that happened around those pre-COVID highs. We wrap around 3,400, and then, November starts and we zoom higher. But small caps, all these charts, all these indices, they have the same range. Same range. It was a wild few months, and obviously continued higher. But we're back to August 2020 on an absolute basis.
Yeah.
We're 38 months in, and we've gone nowhere.
It's a pretty incredible. And the thesis would be, if we're going to see more stocks participating, more than just, the largest cap stocks, that small caps have to hold this level. Micro caps have to reclaim. I would even say internationally, when we look at things like the total world stock index, like using Vanguard VT.
Yeah, that's a great chart you brought. That's a clear line in the sand there. What is that, 94, 95?
Right. Yeah, $94 that we're now below. If we can't hold that, what kind of information does that provide? And if we continue to close lower, and let's just call it a 200-day moving average, we know that nothing good happens below a 200-day moving average. And so if we're going to sustain trade below a 200-day moving average, and just for the record, the areas that are below a 200-day moving average are equal weight S&P 500, small caps.
I'm sure reverse weight's on there.
Yep. Reverse weight using something like YPS below a 200-day moving average. small caps using IWM below a 200-day moving average, micro caps using IWC below a 200-day moving average, even the Dow Jones sitting below a 200-day moving average. Really, the only things that are above a 200-day moving average currently are the NASDAQ 100 and the S&P 500.
And then the sectors that,
Oh, sure. Like, yeah.
and then I would
yeah,
say a few, and so
like technology and
that totally makes
semiconductors.
sense because, it is what it is. And, I hope no one takes what we're saying as whiny. It's just the way the market is right now. There's a non-zero chance that when my son is my age, that Apple is 75% of the S&P, because we're just going to do this for 2 decades. Like, that could happen. Now, that is a super extreme hyperbolic example.
Right.
But can you continue to see Apple and Microsoft, right? These are just formulas. These are just the way the indices are weighted and constructed in this environment.
Right. Well, and it's the very definition of momentum, right? The bigger get bigger.
Yep.
It's the math equation of percentages or compounding on things that are large. If you have something that's 100 and something that's 50 and both appreciate by 10%, well, one is appreciating by $10 and the other one's appreciating by 5, double. So it's that compounding effect that happens within indexes, and that's perfectly fine. That's not what we're here to point out. It's just that we continue to be, I feel like we've been talking about this way for the last 4 weeks, is we're at this pivotal point or this area of confluence where we've seen this borderline flushing of breath, where, for example, we're approximately near about 40% of the S&P 500 is above a 200-day moving average. So think about that. So the S&P 500
40%.
Yeah. So the majority of stocks in the S&P are actually below its 200-day moving average, and the S&P is above it. When we look at the 50-day moving average, about 25% of stocks are above its 50-day moving average. And this is one of those areas where when you see this happen, the way I would describe it is a stretched rubber band. And this is either going to go one of 2 ways. Rubber band is going to retract into its original shape, and that's going to mean a broadening out of stocks across everything. You're going to see buyers show up in small caps, micro caps, S&P 500, or there's some type of snapping event and we see stocks collectively, correlations go to 1 and we move lower. And this goes back to October can be an amplify type month. That's not what we're calling for, but we're definitely in that area. We're in this vicinity of, you see the rubber band stretched. What's the result? We haven't had that yet. Is that a fair summary or analogy that I can use, Ian, to describe kind of the environment where we are at currently?
Yeah, the rubber band does continue to stretch. I guess you could always just rubber band breaks.
Well, that's what I mean. There's either the rubber band is retracting and we're seeing stocks as a whole move higher, including small caps, or the rubber band snaps and we're seeing stocks collectively move lower, and we're kind of in that pivotal point right now here in October, and we're right up against all these important levels. Small cap, IWM being in this.
It's got to do it.
It's got to hold right here.
And it did it last week, but then now, we're back to where we were the lows of last Friday.
Mm-hmm.
We had the bounce. We had 2 days of pretty solid follow through. Since Wednesday, we've given that all back.
Well, not all small caps are the same either. Like industrials are doing well in that area, like small cap industrials.
Yes.
But not all areas of small caps have done well.
Small cap industrials by far, they're better than small cap tech.
Well, that's another interesting dynamic is when we think about lots of, if you were to ask a lot of surface level analysis, what's holding the market up? People would say tech. Well, yes and no, because small cap tech versus cap weighted tech is now also approaching COVID lows or post COVID lows. Like when we look at something like PSCT, the small cap ETF for small cap tech, like it's not a pretty picture, but yet you look at a QQQ or a large cap tech that's holding up very well on an absolute basis.
And you've had some pieces, right? Semis have hung in there. recently the like cybersecurity stuff. If we look at things above a relative relationship, 200-day moving average. You get your Qs, your mega cap growths, your large cap growths, semis, internet is going to be another big, basically large and mega cap. But a lot of those other areas, yeah, whether it be software or cloud computing or I mean, how about like the ARC stuff? I know the ARC's not necessarily tech, but from a relative perspective,
Supposed to be innovative stocks. It's
yeah,
supposed to be
innovate. Yeah, I mean, we got again Fangs hanging in there, IPOs close, fintech horrible, metaverse not that bad on a relative. Yeah, online retail. I'll throw that in tech. Yeah, it's the big boys. It's the point is it continues to be the big boys. I know that has been the story for 10 months. I don't get to pick how they behave. I only can come on here once a week and report on them with you, Dave.
Yep.
We're just given what we are given, and Dave and I pass on, I would say, our take on the truth of the situation. The same theme we've had all year continues to be a theme.
Yeah, it's a mixed bag. You have large holding up well, small caps at a pivotal point, and this is the point in the season, in the point of the year where you would see an expansion. And we haven't seen that. And when we look at with the weekly data as we have it right now, sitting before a market close on Friday the 13th, which sounds very scary. But we've seen other bottoms take place in October. We've mentioned that it can be a bear killer, but it's also an amplifier. If we see small caps break down, if IWC microcaps continue to break down, if we see the total stock market index using something VT break down, that's going to be a resumption of the bear. Wouldn't that be something? Because I know there's plenty of data out there that shows us that this response we've seen since the October lows of 2022,
weak.
It's relatively weak.
And I think even Ryan Dietrich had, so a year ago today, it's exactly a year ago today, we got the big bullish engulfing candle on S&P and other major indices. And yeah, I think he said that this is the worst if, a new bull market, that's what this is. It would be the worst start since 87.
Also interesting that's kind of developing now is we know that the dollar plays a role in this, right? Anything priced in dollars, it matters.
I'm glad you brought that up. What do you think about the move in gold today?
I think it's significant. And what Ian's alluding to is when we look at gold, the move today of 3+% is one of the larger moves since we've seen since February of this year. And then I would say since October, November of last year.
Agree.
And this is happening, though, with a rising dollar.
Yeah.
And so we got to pay attention to that, right? I would think that if gold is rising with a rising dollar.
Yeah, because the last time I did this, you had a fail breakout on the dollar, and we did move lower for.
But on a weekly time frame, I mean, we're putting in a pretty big weekly candle that we haven't seen since November of 2022. And that was the start of off the bottom of a range.
Yeah.
And November of 2022 was when we kind of saw the dollar start to sell off.
Yeah, and this back above 1900, kind of back in this range, I guess you could call it that.
But the gold thing is significant because that range between 1670 and 2000 on gold futures is a massive consolidation that's taken place since April of 2020. And this is October 2023. So we're talking plenty of time, a massive range that's wrapped around the highs from 2011. That could you see gold move much, much higher from here? You could.
That would be the, thesis that, right? That's what a technician would say. The trend will continue from where it can in the direction that it started.
Right. And what you'd like to see, like confirmation of that, would be seeing gold miners outpace gold itself. And on a relative basis, when we look at something like GDX versus GLD, so the ETF of gold miners versus the ETF of gold, we're at this really important horizontal level that could we see gold miners outpace from this point forward? Maybe. That's TBD, but I guess we wouldn't be surprised if that took place from this point forward.
What do you think about silver versus gold?
when you look at the precious metal space, a good characteristic to see is that you would see silver outpace gold. It's kind of that risk on in for that particular area. Like it's great to see small caps and micro caps outperform or be moving from lower left to upper right, because that signals risk on behavior. You'd want to see the same thing. You'd want to see silver outpace gold. You want to see silver miners outpace gold miners. We're not seeing that yet, but we're at important horizontal levels where maybe that could start to happen.
Okay.
Maybe. I don't know. What do you think when you look at that? When you look at like some of the precious metals and the miners, what do you see in that space that sticks out to you?
Yes, if I look at SLV, I like that it's holding $20 area. Go all the way back to August 2016. Those were some highs there. The $18 to $20 area seems like a pretty big range that if you are bullish on silver, you would want to stay above. Obviously, today's bounce certainly helping that thesis. Palladium, right, this is kind of getting into the weeds. Palladium's still weak, and I don't know. I don't have enough historical data that says for gold and silver to be bullish that palladium's got to do anything. But on a relative basis, an interesting spot.
It definitely is. What makes it interesting, to Ian's point, is that this is just happening in an area of dollar strength.
Yeah, dollar strength, right? And we've talked about dollar strength with crude too.
Right.
My thesis, I guess I go back to, is it is unusual, but would we be at $120 a barrel without a strong dollar?
Could be.
I don't think you're going to convince me that the dollar, it's denominated in dollars.
Right.
I do think that there's an impact there, and a rising dollar is a headwind, but yet you've still had, and it's not just crude. There's other things. Look at sugar. I think sugar's back to new highs this week. These are all things that are denominated in dollars.
Right.
So in theory, if nothing changes, except for in this case, the denominator, yeah, I mean, who knows where some of these commodities could be if we actually had a weak dollar. Oh my God, I don't even want to think about what we would be paying.
Well, and I know one of the, dare I say it, fundamental reports out this week was the Consumer Price Index, inflation and inflationary measurements. When we look at gauges that we can use to identify inflation or things that might benefit from an inflationary environment, you could look at something like TIP, right? The ETF for inflationary bonds versus like an IEF, which would be your intermediate, like your 7 to 10 year treasury note. When we look at that relationship, and let's say we put that on the screen, and then on the next screen, and when I mean screen, I mean like actually your computer screen, and on your next screen you put oil, there's definitely a correlation there.
I like that.
And are we about to see a move higher in oil and inflation? Because I mean, after all, it was just transitory, Ian.
That's what Janet promised.
Yeah. As much as I love her haircut, I'm not sure I'm good with her forecast.
Inflation with a strong dollar. Isn't that incredible?
Yeah. Think about that. A strong dollar and you're seeing inflation. I think that's worth pausing and thinking about, because some of the relationships that we're seeing and the oil thing matches what we're seeing. We're still seeing strength out of energy this year.
Yes, we are. And especially as of late. I mean, it's by far your broadest. We talked a few minutes ago about, XLK is leading, and maybe a few things under, sub industries XLK are, holding up on a relative basis. But when you look at energy, it's like everything. It's not just XLE and then a few spots. XLP, XES, MLPs, however you want to divvy that sector up, they're all pretty solid.
Right.
Or Q1 2022, before everything fell apart. Not saying that's an omen, but
it doesn't have to be an omen. And when we think about these different areas of strength that we're talking about, big cap tech, small cap industrials and energy, that's a pretty big juxtaposition. But let's think about it. Like, if you are a large tech company that has multinational exposure. So you're not just here domestic, you're international. And we've talked about this in the past. You probably have some interest rate moat around you that you're able to withstand.
For sure.
If you are small cap industrial and small cap energy, you're actually dealing with raw products, whether it's coming out of the ground or you're making them, that has tangible value, which is different than a small cap tech, which doesn't have tangible value, which makes sense in a rising dollar environment. And so these themes continue to play out. Now we would just like to see a broadening out. That would be the next.
That'd be ideal.
That would be ideal. That would be the next phase in a potential bull leg higher, right? Because markets do work in 2-year cycles. You know, if you think about 2-year cycles using something like EQAL, which is an ETF that represents the Russell 1000, you had a 2-year period of 2016 into 2018. We were rising in an uptrend. Then we moved sideways 2018 into 2020. Then 2020 through 2022, we rose. And now we're 18 months into a sideways, right? So we trend, we move sideways, we trend, we move sideways, we trend. And these happen in 2-year cycles. This is about where we want to see EQAL or the Russell 1000 or IWM, the Russell 2000, hold their ground and find demand without us having to go to your Hungarian neighbors to get it and see an uptrend resume. We don't know that until later. We're not going to know. Like, then that's the hard part about markets is you're not really going to get a prediction on this show. That's not really what we're about. It's about analyzing supply and demand. And right now
I don't know if we're coming up on almost 4 years of doing this, Dave. No, is that right?
Well, this is what? We're in the 170s of episodes.
We probably do 40 a year, close to 40, 45 a year. So yeah, by the time we get to December, we'll be at like 190, 200.
Right. So almost, almost 200
4
episodes.
years. So in 4 years of doing this, I don't know if we've ever given a prediction. And I'm going to pat myself on the back for that. And I'm going to pat you on the back for that.
Yeah, absolutely.
I genuinely, and I mean that, and someone, you can go back through all the episodes and maybe I'm totally misspeaking, but I think that's a great point. I don't know if we've ever come on this show and said X is going to happen.
Nope. It's more life-based in the fact that if this, then that. So if small caps, if IWM is going to be below 170 or 165, that's a problem. I don't know that that's going to happen. I just know that below that level, it's a problem. Same with IWC.
Below that, you can't go higher.
Right.
Because that's the way
numbers work and math works. And
go in order.
Or IWC below 100, as it is right now. That tells us that supply has more impact than demand. And so I agree with you. Like, why would we get in the prediction business? Even though it's weird that the human psychology loves predictions.
I do like it.
What's going to happen next, Ian?
People find comfort in predictions. Well, headlines are made off of predictions.
Sells a lot of commercials.
Predictions are a huge business. I would like to think that I'm just not smart enough to know what happens next.
Well, and I would make the argument that no one is, except the good Lord Almighty.
I can make some good risk-reward bets, trades, but I don't know if it happens. I just know if I'm wrong, I can get out with a small enough loss to not be totally screwed over.
And that's the point of technical analysis or the study of supply and demand is it's not about making a prediction. It's about being able to manage risk. And right now we have risk in the market. The risk increases with the levels that we just already pre-identified, whether it's the 4180 level in the S&P 500, whether it's the 165 to 170 level, small caps using IWM, whether it's the $100 level in microcaps using IWC, even internationally, if we look at something like the Vanguard Total World Stock Index, which does include U.S. stocks, but below $94, or if you're using VEU, the Vanguard measurement of all the world stocks minus the U.S., we're below a 200-day moving average. This $50 level becomes increasingly important. It's not about predictions, it's about having a plan. So what is the plan? So if you think about most asset managers and their portfolios, it's either buy and hold, so you're just going to write out everything, or you're making some type of prediction, which you have no way of garnering when that prediction is wrong. And that becomes problematic, where we could just have a plan that, for example, an ETF that uses a 5-day and a 200-day moving average, that when one is below the other on a Friday, that's when it moves to cash and T-bills. That would be a risk management protocol. And that, I guess I'd like to highlight one of our supporters of the podcast, the Adaptive Select ETF, which is listed on the NYSE under ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. As always, investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. Ian, we've covered a lot of some international, mainly domestic. We haven't touched base on bonds or commodities. Some commodities. We talked about gold
And oil.
and oil. Anything that you want to?
Bonds rough. I mean, they're green this week, but how you can even begin to think about bonds until TLT is above 92.
Well, and there was a 20-year stretch, and I might be exaggerating, that aggregate bonds using something like AGG maybe had one negative year, and now we're borderline.
Yes, one in like 20 or 30 years.
Right, and we're borderline going to be sitting on two
back-to-back
negative years, which isn't that the environment you would see when the interest rate cycle is changing? Is that bonds and credit?
It's so weird that it's hard for people to fathom that. Like, yeah, I mean, if we're truly going into a 30 or 40-year upcycle in rates, probably going to have a lot of negative AGG years.
Well, and that upcycle in rates, we know from history that upcycle previously ended in the early 1980s. And during the previous 35 to 40-year cycle in rising rates, you had the go-go years of the 50s and 60s, which had your Nifty 50.
The Nifty 50.
And the Nifty 50, which, when we do our research, we know there's not a concrete, what were the Nifty 50? There's a general consensus on it was.
I didn't know that till we talked about it yesterday. I always thought that the Nifty 50 was a pretty set list of 50 stocks.
And I think this goes similar in our era. It's very similar to saying, what are your FANG stocks? So are we saying FAANG? Are we saying FANG? Are we saying FAAMG? So some would call it the Magnificent Seven, but are we including NVIDIA? Are we including Microsoft? Are we saying both Amazon and Apple? And that's that same ambiguousness where in general, we know the term. I think that's what the Nifty 50 was in the 50s and 60s. In general, these were the 50 stocks with, let's call it 10 to 20% of the stocks being interchangeable on the periphery. And is that the era we're in now with these multinationals, the big caps? Time will tell. No idea. And we haven't even talked crypto this week. We've got crypto, if I think of Bitcoin
hanging in there,
yet below a 200-day moving average.
200 rejected at the 200-day this week.
And so there's plenty of things below a 200-day moving average. There's not many. If there is, it's large cap tech, which includes semiconductors, energy, but it's not the rest of the market. That's for sure.
Nope.
So we've mentioned industrials and energy. You would immediately think, oh, that means value is outperforming growth.
No, banks still having a rough go. Healthcare, of course. I don't know if healthcare gets thrown in growth or value, but.
Well, and healthcare is tough, right? Because you've highlighted in the past, 179 episodes that within healthcare, there's biotech. Where does that fit?
Where's that fit? Because that's not the same as Eli Lilly.
But yeah, on one hand, you've got Eli Lilly. On the other hand, you got medical devices.
Yeah, Eli Lilly by far the standout this year in the healthcare arena.
On the flip side, you've got medical devices using IHI just cratering and breaking important levels even before small caps do. And then you think about growth versus value. And it's not a one-to-one. Utilities, for example, those continue to be, they've rebounded the last, 2 weeks, but they're still below important levels. You can't just marry into one thesis. There's multiple things that are going on, and you have to be able to digest. And that's why that top-down approach matters. Being able to
bear market and utilities lead the way.
Right.
Could happen.
Could happen. Absolutely. And that's the other juxtaposition is you've got coal and uranium heading lower left to upper right. Meanwhile, solar stocks are heading from upper left to lower right, which is not a narrative that you would consider based on the current leadership in Washington. It's just not. But yeah, we got coal stocks and uranium stocks ripping higher while energy, quote unquote, clean energy or green energy moving lower. It's just not a narrative you would hear. And that's why we use charts. It's huge.
You got to win ETF. Can't get a trucking ETF. 205 million. Hey, 205 million in FAN. That's making money. So they're probably not going to shut it down.
So okay, speaking of transportation, one thing I was looking at earlier today is just the abysmalness of jets. So jets being an ETF that represents the airlines. And when you look at that on a relative basis, we're below the COVID lows, just atrocious. We haven't seen levels like this. The airlines in the United States, and maybe it makes sense, right? Like nobody seems to want to keep a schedule. Flights get canceled all the time.
XTN relative chart is yikes.
IYT, another transport ETF, same deal. So we continue to see weakness out of transportation. Doesn't necessarily give you the warm and fuzzies.
Does not. Also below 200 day.
Right. Meanwhile, like if you were to do a comparison of semiconductors being digital, like I'll call that digital transportation versus your tangible transportation using IYT, we're borderline making new highs. So we'll see. We'll see if this market continues to be a narrow market where we're just focused on large cap tech and some of these energy spots. That's TBD. Anything else, Ian, with us bumping up against the end of our time that you want to cover for our listeners that's worthwhile?
I bet, Dave, if you came out with a semiconductor ETF but called it digital transportation,
ooh,
you could raise so much AUM.
Oh, I
that
believe it.
Sexy, dude.
Yep, digital
Even if it was
transportation.
just SMH, but with a new title.
Yep. Digital transportation. People would love that.
I don't have anything else. We've gotten everything off our chests that we need to this week. It just continues to be kind of a blah market. And maybe we're up 4% on Monday. I don't know.
Right.
Could happen. And then we're off to the races and we never get close to 4180 again.
We'll be able to say, look at episode 180 when these guys were being a little bit grumpy just because we've been in a grind for 18 months with this market. Maybe we're moving much, much higher. Because after all, I mean, there's data out there like the CTA positioning. CTA is just being your commodity trading advisors. But the interesting thing, I don't know why they call them commodity trading advisors because they have equity positions. Anyway.
I've never understood that. I've never understood the CTA.
Why they call them that when they have massive equity exposure.
Yeah. I mean, Jerry Parker trades 300 different. You can have 300 different positions. And I know he's a CTA and I know those aren't all commodity futures.
Right. And they're definitely owning equities. And here's the fact is we're seeing CTA positioning where they're super short this market in the about 50, I think $50 billion is the mark. And these are levels that we haven't seen from CTAs since basically the October low, or when you think about the COVID low, the levels that we're seeing positioning wise for shorts. Again, this goes back into the fuel is sitting there for upside, where if we get some type of short squeeze, if we get small caps to hold here, you get micro caps to hold here or reclaim prior lows. We hold the 4180 level. We don't close below 200-day moving average on S&P nor the NASDAQ. You could see a squeeze happen here that causes the market to rip. That's TBD. Now, I will say these CTAs once in a while get it correct.
Yeah.
And what I mean by that is like your Lehman Brothers event in 2008 being positioned for the waterfall effect that took place in 2008. I'm not calling for that. I don't want to be alarmist, but you just can't take everything in a vacuum. but we are at levels, short speaking, with billions of dollars in position that you could see a short squeeze through the end of the year that would surprise. But until we see that, I mean, we got to get it back above important levels. S&P 500 has to get back above 4,400. It's really that simple. So we kind of went off on a little tangent there as I was trying to close things down for this episode, and I may have cut you off, Ian.
No.
Was there anything you want to touch base on before we get out of here?
I don't. Just want to wish everyone a happy weekend.
Excellent. Well, we appreciate it. If you enjoyed these podcasts, these episodes, give us a high ranking, share it with your friends. We really appreciate it.
Have a great weekend, everyone.